Bitcoin is still traded as a risk asset, even though, as you know, I think it should be traded as insurance.
In today's video, Canadian individual investor and former hedge fund manager Greg Foss discuss what will gonna take to see Bitcoin go up again, and why the fiat Ponzi is running out of time.
Boy, are we in trouble. You've seen some crazy announcement out of the Bank of Japan today, for example. It reminds me of my time in the great financial crisis, when every single day you had some sort of talking head from the finance circles, whether it was the head of Lehman or the head of Bear Stearns. Oh, don't worry, everything is just fine. Nothing to see here. As soon as the talking heads start saying stuff like that, you know that there's some approaching flames, and a little bit nervous, to be honest.
What is it going to take to see Bitcoin go up again?
It will be some sort of event that comes out of left field. Something like Russia pricing oil and natural gas in Bitcoin. Something like a central bank of a large country divulging that they've accumulated a certain amount of Bitcoin and plan to accumulate more of it. Or perhaps it's nothing more than education, where people realize that every single asset in the world is being debased because of the Fed policy. Let's get on board an asset that is programmed to increase in value, whose monetary supply is written in math and code. So education's the long run. The short run would be something like an announcement. And then the real one will be, or a very potential one, is when the Fed pivots. The Fed pivot will increase values of, or stop the bleeding in a lot of risk assets. And unfortunately, Bitcoin is still traded as a risk asset, even though, as you know, I think it should be traded as insurance. I'm not bigger than the market. You got to watch what the market's doing, not what you believe. So lots of ways it could happen, but unfortunately, there's lots of ways it could still, experience some downdrafts, no question.
Well, I know you don't have a crystal ball, but just given the macro environment right now, what will spark the Fed to pivot? What do you think is going to break down in the system, knowing everything that's happening from Europe to Japan and beyond?
Look, Japan. I mean, there's all sorts of things that could happen. You already have some Fed governors that are talking back the assumed 75 basis point increase that's coming in the next 2 weeks. There's Fed governors are smart enough to read financial markets. Today's close on the equity markets was pathetic. Financial stocks took a huge gap lower at the end of the day. Business confidence is at all-time lows, literally all-time lows. This is not good for the economy. And the USA is going to have to choose whether it wants full employment or control inflation, but it's not going to be able to do both, okay? The likely pivot comes, in my opinion, where they change their inflation target, where they move it from 2% to something like 4%. Then they declare victory and say, okay, so now we have 4% inflation targets, so now we can afford to stop the tightening cycle. It's always that, Nat. It's always smoke and mirrors with the Fed. They talk a big game and then they pivot because the markets and the US dollar global wrecking ball is destroying emerging markets right now. Historic losses in emerging markets. Well, when you have historic losses of capital in emerging markets, those are your trading partners. Those cause global GDP to decrease. A global depression is in the offing, and I think the Fed will pivot. I'm not certain of it because I think that Jerome Powell is not the right man for that chair. He's a lawyer. He is not a risk manager. Well, it's hard to say what's happening with the bond market because it's so manipulated. The yield curve control, the desire to keep the 10-year rate at 25 basis points has hit some bumps, but it's all guns blazing. The bigger concern that I had was when the Bank of Japan, one of the governors, came out today, I can't remember who it was, and basically said, it's all fine, as I mentioned earlier. Well, chances are it's not all fine. And why is that? Because Yellen very quickly thereafter went on tape saying, oh, the USA and Japan are going to explore all ways of controlling the yen and keeping things stable, if you will. That's just another way of doing quantitative easing that Bernanke said many years ago, that the way the USA could invoke quantitative easing is by participating in foreign countries' debt markets. Well, it looks to me like they are potentially going to invoke quantitative easing in Japan as some backdoor methodology of employing QE across the world, just not in the USA's debt markets. And here's the funny thing, Preston Pysh jumped on this immediately, and he basically sent out, oh, okay, so that's what the US taxpayer money is going to be used for. Is it to support the bond market in Japan at manipulated below market rates? So what a bit of a circular logic, a bit of a cesspool of old banker thinking. But yeah, it's not pretty. I honestly cannot think of anything they're doing right. Okay. Like, I think they are absolutely very juniors in the room. They are not listening to the markets. They are using backward-looking data, okay? Employment reports are backward-looking. They're not looking to financial conditions. They're not looking at credit spreads. They're not looking at the jamming up of financial markets. You know, this is a situation where you have a guy that's trying to be like the old Paul Volcker, okay, the Fed chairman in 1982 that arrested inflation in 1982. The difference is that the debt situation in the world is about 3 times larger than it was when Volcker used the same tactics. It doesn't work with a global debt spiral that we're in. That we've talked about this. Someone asked that question. Total global debt to GDP is 400%. It doesn't work, okay? There is a limit that you can increase interest rates before the whole system explodes. It's like the central bankers haven't even done the math. It's very concerning. So I'm afraid I can't think of anything they're doing correctly. If they laid out that they've actually done the math, then I'd have more confidence in it. I don't believe they've actually done the math. The credit default swap markets on sovereign debt to provide a valuation matrix for Bitcoin. It's done through a credit lens, not because that's where my experience has been. I spent entire career in credit markets, as you know, so I always start an analysis with a credit perspective. I like to think of Bitcoin as essentially a credit default swap on a basket of fiat currencies. And that is to say that you are buying insurance on the potential default of some of the currencies in that basket.